Dividends. Everyone loves them. Your broker loves them, finance influencers love them. But today, I'm going to show you both sides. The good, the bad, the traps, and exactly when dividends will make you rich and when they'll hold you back. Stay until the end because I'll show you real companies, some that are printing money for investors and some that are literally paying dividends they cannot afford. Let's go. Okay, let's start from zero. What even is a dividend? When you buy a share of a company, you become a part owner of that business. And when that business makes a profit, it has two choices. Choice 1. Reinvest that profit back into the business. Buy more equipment, hire more people, expand into new markets. Choice 2. Share that profit directly with shareholders. That's a dividend. Cash sent straight to your brokerage account. Simple as that. Now, dividends are usually paid quarterly. That's 4 times a year. Some companies pay monthly, some annually. The amount is measured as a dividend yield, which is the annual dividend divided by the stock price. So if a stock costs $100 and pays $5 a year in dividends, that's a 5% dividend yield. But here's what most beginners don't ask. Why is this company choosing to pay me instead of growing? And that question changes everything. There are 4 key dates you need to know. Declaration date. The company's board announces the dividend. We're paying X amount. Ex-dividend date. This is the cutoff. You must own the stock before this date to receive the dividend. Buy it on or after and you miss the payment. Record date. The company checks its books. Who owns shares right now? Payment date. The cash lands in your account. Now, where does this money actually come from? Companies pay dividends out of their free cash flow, the cash left over after all operating expenses, taxes, and capital investments. Healthy dividend companies generate so much cash that they can reward shareholders and keep growing. Think of companies like Coca-Cola, Johnson & Johnson, Procter & Gamble. These are massive, dominant businesses in industries that don't disappear. People will always buy Coke, always buy shampoo, always need medicine. That stability creates a river of cash, and dividends are how they share it. But what happens when a company wants to look generous but doesn't actually have the cash? We'll get to that, and the examples will shock you. Alright, let's talk about what nobody in the dividend community wants to admit. Reason number 1. Dividends kill growth. When a company pays you a dividend, that money is gone from the business. It cannot be used to build new products, enter new markets, or crush competitors. Compare this. Amazon paid 0 dividends for decades. Instead, they took every dollar of profit and built AWS, Prime, logistics networks. Result? The stock went from $18 in 1997 to over $3,000. A dividend investor would have missed that entire journey. Reason number 2. Dividend yield can be a trap. Here's a dangerous illusion. A stock drops 40%, but the dividend stays the same. Suddenly, the yield looks amazing. 10% yield, buy it. But you just bought a falling company. That's called a yield trap. Reason number 3. Taxes. In the UK and most countries, dividends are taxed as income. Capital gains often have more favorable treatment or can be deferred indefinitely. So dividends can actually be a less tax-efficient way to receive returns. Reason number 4. Dividend cuts are brutal. A company can cut its dividend at any time, and when they do, the stock often crashes, because institutional investors read it as a distress signal and sell immediately. So now you might be thinking, why does anyone invest in dividends at all? Here's the other side, and it's genuinely compelling. Here's the truth. Dividends aren't good or bad. They're a tool, and like any tool, it depends on how and when you use it. Scenario 1. You're retired or need income. If you've built a $500,000 portfolio and need it to generate monthly income, dividends are incredible. A 5% yield gives you $25,000 per year without selling a single share. Your capital stays intact, your income flows. Scenario 2. Bear markets and crashes. When markets crash, Growth stocks can drop 50 to 70%. But dividend stocks, especially from essential industries, tend to be far more resilient. And while you wait for recovery, you're still getting paid. Scenario 3. Compounding with DRIP. DRIP is Dividend Reinvestment Plan. Instead of taking the cash, you automatically buy more shares. Over 20 to 30 years, this compounding effect can be extraordinary. £10,000 invested in a dividend stock at 5% yield, reinvested for 30 years, grows to over £43,000 just from dividends alone, before any stock price appreciation. Scenario 4. Stability and psychology. Getting paid while you wait is psychologically powerful. Dividend investors are statistically less likely to panic sell during downturns because they're still receiving income. So who are the gold standard dividend companies? The ones that have been paying and growing their dividends for decades? Let's look at the real examples. Let me show you how a professional investor evaluates whether a dividend is safe or a ticking time bomb. The 5 metrics you can check. Metrics. Payout ratio below 60%, earnings going to dividends. Free cash flow payout ratio 70%. Dividend coverage ratio above 2 times. Dividend growth history 5+ years of consecutive increases. Debt to equity low and stable. Now the dividend aristocrats. These are S&P 500 companies that have increased their dividend every single year for at least 25 consecutive years. Example 1, Coca-Cola, KO. Coca-Cola has paid and raised its dividend for over 62 consecutive years. Dividend yield 3%. Payout ratio 70%. Free cash flow payout 73%. Why they can afford it? Coca-Cola sells in 200+ countries. Their brand has almost zero competition at scale. They generate billions in free cash flow every quarter. The business is essentially a cash machine. Warren Buffett owns over 400 million shares. He personally receives roughly $750 million per year in Coca-Cola dividends alone. Example 2, Johnson & Johnson, J&J. Dividend yield 3.2%. 60+ years of consecutive dividend increases. Free cash flow payout 49%. Why they can afford it? Healthcare is non-cyclical. People need medicine in recessions and booms. J&J's diversified portfolio across pharmaceuticals, medical devices, and consumer health creates enormous predictable cash flows. REIT. Example 1, Realty Income Corporation. O. Special mention, this is a fan favorite dividend stock. Realty Income is known as the monthly dividend company. They literally pay dividends every single month, not quarterly. Dividend yield 5.5%. AFFO payout 76%. REITs use AFFO, adjusted FFO, not FCF. 76% AFFO payout is healthy for a REIT, legally required to pay 90% plus of taxable income anyway. They own 15,000 plus properties leased to tenants like Walgreens, Dollar General, FedEx. As a REIT, real estate investment trust, they're legally required to distribute at least 90% of taxable income to shareholders, which is why REIT yields are so high. Their tenants sign long-term net leases, meaning the tenant pays property taxes, insurance, maintenance. Realty Income just collects rent. REIT example 2, Vici Properties, VECI. Dividend yield 6.3%. Vici owns casino and entertainment real estate. Properties like Caesars Palace, MGM Grand, and Venetian in Las Vegas. Their tenants cannot leave. It's nearly impossible to move a casino. These are 30 to 40-year leases with built-in rent increases. This makes Vici one of the most defensible dividend payers in the REIT space. Those are the gold standard examples. Now let me show you the dark side. Big-name companies that are paying dividends they genuinely cannot afford. Companies that cannot afford their dividends. This is the most shareable section. This is where it gets dangerous. Some companies pay dividends not because they're healthy, but because they're afraid to cut them. Cutting a dividend signals weakness. The stock crashes. The CEO gets fired. So instead, they borrow money or sell assets just to keep paying shareholders. That is a house of cards. Example 1, AT&T. T. AT&T was once considered the ultimate dividend stock. For years, it yielded 7 to 8%. Investors called it safe. Then reality hit. AT&T took on $180+ billion in debt after acquiring DirecTV and Time Warner, deals that destroyed value. They were paying dividends while burning through cash and drowning in debt. In 2022, they cut their dividend by nearly 50%. The stock collapsed. Investors who chased that safe 8% yield lost 40 to 50% of their capital. Lesson: a high yield on a debt-laden company is not income. It's a warning sign. Example 2, Walgreens Boots Alliance, WBA. Walgreens was a dividend aristocrat, over 45 years of consecutive increases. Then, their pharmacy business faced brutal competition from Amazon and online pharmacies. Store foot traffic collapsed. Free cash flow dried up. In 2024, they cut their dividend by 48%. The stock had already fallen over 70% from its peak. Lesson: past dividend history does not guarantee future payments. Business model disruption kills dividends. Example 3, Pfizer, PFE. After COVID vaccine revenues collapsed post-2022, Pfizer's earnings fell dramatically. Dividend yield rose to 6 to 7%, but largely because the stock price had cratered, not because the dividend grew. Their payout ratio exceeded 100%, meaning they were paying out more in dividends than they were earning. Lesson: when payout ratio exceeds 100%, the dividend is being funded by debt or cash reserves. That's not sustainable. Dividends are not universally good or bad. They're a tool. Use them if you need income, want stability, or are in the wealth preservation phase of life. Avoid them if you're young, have a long time horizon, and want maximum growth. Your money often compounds faster in companies that reinvest everything. And always, always check the payout ratio, the free cash flow, and the debt level before trusting any dividend. The best dividend is one paid by a company so strong, so dominant, so cash rich, that the dividend is just the overflow from an unstoppable business. If you want to see my actual dividend portfolio, what I hold, what yields I'm getting, and how I'm building passive income alongside my growth positions, comment dividends below and I'll do a full portfolio breakdown video. Don't forget to like, subscribe, and hit the bell. I drop new videos every week for investors who want to actually understand what they're buying.